welcome to this wonderful chapter bond valuation. We are solving questions on YTM. In the previous lecture we solved one question number 22 by using the formula method and the answer was 9.87. Now I am going to solve the same problem by one more method which is called IRR method. So write down in the notebook question number 22, calculation of YTM using IRR method, internal rate of return method. IRR method gives you more accurate answer. IRR method gives you more accurate answer compared to the formula method. Right. So what was the answer under the formula method? 9.87%. So this is approximate answer, which means a more accurate answer will be also closer to this answer. How do you compute IRR in the classroom? You will take a discount rate assuming that this is IRR. IRR means the discount rate at which NPV will be equal to 0. So we will assume that 9% is IRR. We will calculate the net present value here. If the net present value is 0, our answer is right, 9%. But if net present value is positive, then I will increase the discount rate. In this example, I will increase it from 9 to some other percentage, let's say 10%. And then we will apply one formula of IRR calculation. That formula gives you the answer that what will be the discount rate at which NPV will be equal to 0. So I will tell you that formula a little later. First we will complete this part. So I am assuming that you have studied IRR before this. Okay. So write down year, cash flow, then we'll take one start rate or discount rate 9%. Under that two columns, you're writing in the notebook discounting factor, discounted cash flow. Again write down discount rate 10%, discounting factor, discounted cash flow. See, why we have taken 9 and 10%, the answer for this question is simple. You have already got an answer 9.87. So this answer will also be close to somewhere between 9 and 10. So therefore we have chosen 9 and 10, but otherwise you can take a different rate also. By looking at the question also we can understand this bond is trading at a discount. It is trading below its face value. So in such cases the rate of return would be more than the coupon rate. Coupon rate is 8%. This bond is trading at a discount. So therefore the discount rate or the required rate will necessarily be more than 8%. So that is why we can start with 9 or 10%, and after getting NPV positive or negative you can decide the next rate. Okay. So can we start now? Yes. Write down year 0. In year 0 you write down 925. You have to invest 925 rupees. Then for 5 years 1-5 you will get 80 rupees. For 5 years you will get 80 rupees, and then in the 5th year you will get 1000 rupees. In the 5th year you will get 1000 rupees. So these are the cash flows. Now discounting factor at 0 for year 0 is always 1, that you know. Now take your calculator, 1-5 and 9% annuity factor. So that is 3.8897. Check. And the 5th year factor is 0.6499. 0.6499. Now multiply 925. This is 311.176. 311.176. Check. And this is 649.90. Now tell me the net total. Take total of these two number, positive number, minus 925. How much is the answer? Yes, The answer is 36.076. This is positive, which means I have to increase the discount rate. Higher the discount rate, lower the present value. My target is to reach an NPV equal to 0. So I have to take a higher rate now. So please come to 10% here. Discount rate 10%. Start year 0, 1. 1-5. 1 upon 1.10. 5 times equal to GT 3.7908. Fifth year factor 0.6209. Now multiply cash flow column, this column, 925 into 1, 925, 80 into 3.7908, 303.264, 1000 into 0.6209, 620.90. Take the total of this. This is 0.836 negative. Check 0.836 negative. Now understand the IRR calculation. At 9% it is positive. At 10% it is negative. So that means 0 lies somewhere between these two extremes, which means the IRR lies somewhere between 9 and 10%. So how to get that IRR? For that, now there is a formula which you have studied in your financial management subject, capital budgeting chapter. So write down below the table. Below the table write down YTM is equal to start rate plus surplus upon surplus plus deficit into end rate minus start rate into end rate minus start rate. In some books they write like this also. That also, if you know, you can write is lower discount rate plus NPV at lower discount rate upon NPV at lower discount rate plus NPV at higher discount rate, and then into higher discount rate minus lower discount rate. Doesn't matter because you are using only different terminology. Lower discount rate means start rate. NPV at lower discount rate means surplus, and NPV at higher discount rate means deficit. And then take the difference between end rate and start rate. I hope you have written the formula. So now I am going to write the numbers. So how the numbers will be presented? Start rate is 9 plus surplus is 36.076 upon 36.076 plus deficit, you write the number positive 0.836. 0.836. That means basically in the denominator we are writing the difference between the NPV at lower discount rate and NPV at higher discount rate. Okay, so this is the actually difference between NPV at HDR and LDR, lower discount rate and higher discount rate, into 10 minus 1. Now take your calculator and solve. Take your calculator and solve. First solve this part into 1 and then plus 9. So that will give you 9.98%. 9.98%. So this is a more accurate answer. This is IRR method. Okay. This is a more accurate answer because it takes into account the time value of money. So then your question will be, should we follow formula method or IRR method? For a coupon bond, you can follow any of the two methods. Both are okay. Now what is the logic of IRR formula? Let us just revise. Logic of IRR formula. Okay, it is just based on what is called interpolation. Now how does it work? Let us see. When the discount rate was 9%, discount rate was 9%, the NPV was 36.076, right? And when the discount rate was 10%, the NPV was negative 0.836. When discount rate was 9%, NPV was 36.076. When discount rate is 10%, NPV was negative 0.836. Now you see here, I will write on the left side. What is the change in discount rate? Change in discount rate from 9 to 10 is 1%. What is the change in NPV? Change in NPV. Now you see, NPV was earlier positive. It became negative. So from positive, it became negative. So I have to take 36.076 minus minus. So minus minus will become plus. So change in NPV will be 36.076 minus 0.836. So when the discount rate changed by 1%, the NPV changed by 36.076 plus minus minus will become plus 0.836. So that is around 36.912. 1% change in NPV produces a change of 36.912 in NPV. Now you see the arithmetic. When I use 9% discount rate, NPV was 36.076. At 9% discount rate on the screen, NPV is 36.076. We want that this number should become 0. We want that this number should become 0 because if it becomes 0, then we'll get the IRR. So how much change do I need? If I have to make this number 0, how much change do I need? So I need to reduce this number by 36.076, right? So to bring about a change of 36.076, what is the change in discount rate required? So now we are entering into school level arithmetic. In school arithmetic, they were teaching you 1% discount rate changing, NPV is changing by 36.912. So if you want 36.072 change in NPV, by what percentage discount rate should change? So you would have done like this: 36.076 cross multiply 1% and divide by this number 36.912. So you have to increase your discount rate by this percentage which is in the bracket. You will see exactly same thing you have written here in the formula. 36.076 is there, 36.912 is there, and 1% is there. So this percentage, these many percentage I need to increase so that I will reach an NPV of 0. So my starting discount rate was 9. 9 needs to be increased by some percentage, that is 90.98%. That is the logic. So this calculation will give you this, once again on the screen right side below. This calculation is equal to 0.98%. At 9% we are getting positive. If I increase it by 0.98% more, I will get a NPV equal to 0, and that is why my answer is 9.98%. Now dear student, remember, if you are using IRR method and suppose both numbers come positive, this is also positive suppose, and the second number is also positive, then what will you do? Then you will take 36.076 minus this number in the denominator, because I have to calculate the difference between these two numbers. So if both are positive, the difference will be this minus this. If this is positive and this is negative, the difference will be actually this plus this, like we did in the given question. So I hope that helps. It was a quick revision of IRR calculation. Now we'll come to question number 23. A bond of rupees 10,000 bearing coupon rate 12% and redeemable in 8 years at par is being traded at rupees 10,600. Find out the YTM of the bond. So first I will write the formula. It is a coupon paying bond. So for coupon paying bond, we can apply the formula YTM is equal to coupon plus, if face value and redemption value is same, you can write FV or otherwise write RV, minus current price divided by N upon face value plus current price divided by 2. So we can solve by formula. Now you see in this question, discount coupon rate is 12%. So I will take 10,000 into 12%. 10,000 into 12%, 1200 plus face value is 10,000. Current market price is 10,600. So this time this is opposite of the previous question. In the previous problem, the bond was trading at a discount. This time the bond is trading at a premium. Okay, so my final answer would be less than 12%. You will cross check. If a bond is trading at a premium, it means the discount rate used to calculate the present value of the bond is less than the coupon rate. Divided by 8 years upon the average, 10,000 plus 10,600 upon 2. Now please solve it. After solving it, what is the answer? 10.92%. So be careful that this answer has to be less than 12%. Why? Because the present value of the bond or the price of the bond is more than face value. In the question number 1 only we have seen this situation. If the present value or the price of the bond is more than the face value, it means the discount rate, required rate of return is less than the coupon rate. If you give me more than 12% answer, I will understand that yes, this is a wrong answer. Now we'll come to question number 24. A rupees 5,000 bond with 10% coupon rate matures in 8 years and currently sells at 97%. Currently sells at 97% means take 5,000 multiplied by 97%. It means the price of the bond today, current price is 4850. 4850. Is this should a desirable investment for an investor whose required rate of return is 11%? So this question has two parts. First, you have to find out what is the intrinsic value of this bond by using 11% discount rate. Compare the intrinsic value of the bond with the current market price and then take a decision whether you should invest or not. Method 1. And method 2 is what you can do. You can just find out the IRR or YTM of this bond. Find out the YTM of this bond. If the YTM of this bond is more than 11%, you can buy this bond. But if the YTM is less than 11%, then don't buy. If the bond gives you more return than what you want, you want 11, but it is giving more than 11, buy. But if it is giving less than 11, then don't buy. So first we will calculate the YTM. I will solve this problem by two methods. One is using IRR technique, that is YTM versus required return, and second we'll compare intrinsic value with the actual market value. Okay. So let us write down YTM is equal to YTM is equal to C plus FV minus CP upon N upon FV plus CP by 2. After writing the formula, write the answer below. First write one line there, current market price of the bond. Current market price of the bond is equal to 97% into 5000. 97% into 5000 is how much? 4850. 97% into 5000 is 4850. Next is YTM is equal to 500 plus, what is 500? 500 is 5000 is the face value, 10% is the coupon rate, plus redemption value or face value 5000 minus current price 4850 divided by 8 years and upon 5000 plus 4850 divided by 2. So solve now. So when you solve it, what is the answer? What is the answer? Yes, the answer is 10.53%. Very good. This bond is generating 10.53% return. If you hold it till maturity, you will earn 10.53%. And what is your required rate of return? 11%. So should we invest in this bond? No. You will earn less than what you require. So therefore this bond should not be invested in. So write down the conclusion. As the YTM is less than the required return, the bond is overvalued. The bond is overvalued. The bond is overvalued means it is trading at a higher price than what it should trade at. The bond is overpriced means its market value is more than what it should be. The investor should not purchase the bond. The investor should not purchase the bond. Investor should not purchase the bond. And now write down alternatively. Alternatively, we can solve by one more method. The question was, should we invest in this bond if my target return is 11%? So another method is comparing the intrinsic value with the market price of the bond, and then we will take a decision. So write down alternatively, calculation of present value or intrinsic value of the bond. You can write in the notebook, calculation of present value or intrinsic value of the bond. Draw this table with 4 columns: year, cash flow, discount rate at 11%. we want 11% rate of return. So how much we are willing to pay? We can get now using 11% discounted cash flow, DCF. So please start. 1-8 500 rupees, 8th year 5000 rupees. 1-8 at 11%. Take on your calculator 1 divided by 1.11. Press equal to 8 times. Press GT. Check the answer. 5.1461, and the only 8th year is 0.4339. 0.4339. Now what you do? Multiply and take total. You can use memory plus function for quick result. 500 into 5.1461 equal to M plus 2573.05. 5000 into 0.4339 equal to M plus 2169.50. Take the total, it comes to 4742.55. Right? What is the current market price of the bond? Current market price of the bond is 97% into 5000 is rupees 4850. Now compare these two. You are willing to pay maximum 4742. This is the maximum amount you are willing to pay. This will give you 11% rate of return. But the bond is trading at 4850. The bond is overvalued. Okay, not buy. Otherwise, you will not get 11% return. You will get less than 11% return. So write down the conclusion again. If you are following this presentation, the investor should not purchase the bond. The investor should not purchase the bond as it is overvalued. As it is overvalued. What is overvalued? Into bracket current market price is greater than intrinsic value. Current market price is greater than intrinsic value. Now write down next question number 25. Very important, tick mark, very important, 5 marks exam question. There is a 9% 5-year bond issue in the market. 9% is the coupon rate, 5-year is the term to maturity. The issue price is rupees 90. The issue price is rupees 90, and the redemption price is rupees 105. So after 5 years, the bond will be redeemed at 105. For an investor with marginal income tax rate of 30%, that means tax on his income. What is the income in this problem? Interest income. So on interest he will have to pay 30%, and capital gain tax rate is 10%. Capital gain tax means when he will redeem this bond at 105, which he had purchased for 90 rupees, there is a gain of 15 rupees. On 15 rupees gain, he will pay 10% tax, 1 rupee 50 paise. 10% of 15, 1.50. Good news is that there is no indexation calculation required. What is the post-tax yield to maturity? What is the post-tax yield to maturity? Means you have to take into account the tax implication also. There are two tax implications in this problem. One is when you will earn the interest, you have to pay 30% tax on that, and when you will receive the redemption proceed, you will have to pay 10% capital gain tax on that. Now in this question, one important information is missing. Search for that important missing information. So what is the missing information? Have you located what is the missing information? The missing information is face value. face value is not given. 90 rupees is issue price. 105 is redemption price. Face value is not given, so assumption face value is rupees 100. Because normally a bond is issued with a face value of 100, 1000 like that. So if the problem gives you issue price, redemption price which are close to 100 rupees like this, then you can safely assume that the face value is rupees 100. Why I need face value? Because I need to compute the coupon. Coupon is calculated by multiplying the face value with the coupon rate. So face value is 100 means coupon will be 9 rupees. Coupon will be 9. And if coupon is 9, then you have to pay tax on that at the rate of 30%. So that is, I think, 2.70. So what you will get as income net of tax will be, how much is that? 6.30. So in this question your coupon will not be 9, your coupon will be coupon after tax, which is 6.30. So I am going to ask you one question now. What is the redemption value net of tax? What is the net amount the investor will receive on maturity after paying capital gain tax of 10%? He will receive 105, but then he has to pay capital gain tax also. So please answer, what is the redemption value net of tax? What is the redemption value net of tax? 5 seconds more. Okay. Check the answer of net redemption value. So write down first step 1, net redemption value. Net redemption value means after paying tax. That we will call net redemption value. This we will call step 1. Net redemption value, right hand side rupees. Check whether you have got it right or not. Redemption value is rupees 105 less issue price 90. So how much is your profit on redemption? Your profit or capital gain is 15 rupees. 105 minus 90 is 15. On 15 you will have to pay 10% tax without any indexation calculation. So therefore next line write down point number D, tax on capital gain. Tax on capital gain in bracket 10% into 15. 10% into 15. How much is 10% into 15? 1.50. So now tell me what is the net amount. You will receive from the company 105. You will pay tax to the government 1.50. So the net redemption value after tax, net redemption value after tax will be 105 minus 1.50. 105 minus 1.50 is equal to 103.50. 103.50. So that is your net redemption value. For all further calculation now, in the formula net redemption value 103.50 will be taken. Okay. So forget this 105 now. For all calculation in future we will take 103.50. Is it right? Now write down step number 2, YTM. That was the question. What is the post-tax YTM? So this time the formula will also change. Can you see the change in the formula? Now I have written here C into 1 minus T because I have to pay tax on the coupon amount, plus this time I have written redemption value because redemption is not at par, redemption is at premium on which I have to pay tax. So redemption value minus issue price divided by n upon redemption value plus issue price divided by 2. Okay, so these are the full form of the notations used in the formula. RV is net redemption value, IP means issue price, N stands for number of years, T stands for tax rate. Now put the values and solve. So let us solve this wonderful question number 25. So this time you see your face value we have assumed 900 rupees, coupon rate is 9%. So 100 into 9%, 9 rupees is coupon into 1 minus tax rate which is 0.30 plus in bracket 103.50 minus 90 divided by 5 upon 103.50 plus 90 divided by 2. So kindly solve. So what is your answer now? The answer is 9.3%. In bracket write approximately, because you are using a formula which ignores time value of money to some extent. So this formula is approximate, right? This is a 5-mark question. In the exam you can use formula method, but for more understanding we will try to solve this question again by using IRR method. Okay, so write down in the notebook question 25, calculation of YTM using IRR method. Calculation of YTM using IRR method. So this time also if you look at it, the formula method gives you 9.3%. So IRR method will give you some number close to this only. So I can start with 9% as a lower discount rate and I can take 10% as a higher discount rate. So same format, once again write down year, cash flow, discounting factor, discount rate will take 9%, under that 2 columns, discounting factor and discounted cash flow, then discount rate 10%, under that 2 columns, discounting factor and discounted cash flow. So now you solve. Draw the format first. Is the format ready? Say yes. Yes. So year 0, how much will you write now? 90. We have to invest 90 rupees today. For next 5 years, you will get 6.30. 6.30 we have already discussed. If you want to write again, then you write 9 into 1 minus 0.30. 9 into bracket 1 minus 0.30. And then last 5th year, what will you write? 103.5, not 105. Okay, for all calculation now, this will be 103.5, step number 1. Okay, now start writing the factor. 0, year 0 is 1, 1-5, you can copy from previous question where also we have used 9% and 10%. So you can just quickly copy from previous answer 3.8897 and 0.6499. Multiply, take total 90. 6.30 into 3.8897, 24.505, 67.265. First take total of these two positive number minus 90. What is the answer? It is 1.77. Okay. At 9% discount rate, we are getting a positive NPV of 1.77, which means I have to increase the discount rate. I have to reach 0 NPV. So I will take now 10%. already you have calculated the factor in the previous question. So just please copy from there. In some previous problem we have calculated 10% factor. Now write down the multiplication. 90 into 1, 90 negative. This 6.30 into 3.7908 is 23.882, and this is 103.5 into 0.6209, 64.263. Please take the total of these two positive number minus 90. Oh, negative answer, which again means that your IRR or YTM will fall between 9 and 10%. So now we'll apply the interpolation formula. It is more than 9. It is less than 10. So it will be 9 plus something. And that 9 plus something is calculated by using the mathematical concept of interpolation. Right? Already I have given you the logic of this formula, what is inside the bracket. It is just simple arithmetic they are using. So formula is start rate, or whatever formula you know, you write down, plus surplus upon surplus plus deficit into end rate minus start rate. Next line is equal to 9 plus 1.77 upon 1.77 plus 1.855. Check the answer on the screen, into 10 minus 9. Solve it. Waiting for your answer. Come on. So the answer comes to 9.49%. 9.49%. Okay. So this is how you can use YTM by both the methods. In the exam, try only one method, whichever method you think you can do fast and correct. One more practice we will do, and that is question number 26. You are considering investing in one of the bonds. You are considering investing in one of the bonds, and which are these bonds? These are bond A and bond B. Coupon rate 12%, 10%. Maturity is 10 years, 6 years. And price is 700 and 600. Face value is 1000 rupees. Below it is written tax rate is 30%. And capital gain tax is 10%. Tax rate is 30% means on the coupon. Coupon will be 12% of 1000, 10% of 1000. On that you pay 30% tax, and then capital gain tax is 10%. You see on the screen, this bond is currently priced at 700, but the redemption will be at par, that is 1000. So on 300 rupees capital gain, you have to pay 10% capital gain tax, that is 30 rupees. And similarly in bond B, you have 1000 minus 600, 400 rupees is your capital gain, into 10%, 40 rupees you have to pay. So what is the post-tax yield to maturity? Exactly same problem like your previous one, but this time there are two bonds. So first you prepare one step 1 like I did earlier, exactly same sequence, calculation of net redemption value. Calculation of net redemption value. So please do it on your own. After doing it on your own, then you compare with my answer. Right hand side 2 columns. Bond A, bond B. Bond A, bond B, then write down redemption value. redemption value 1000, issue price 700, 600, capital gain is 300, 400. Capital gain tax 30 and 40. Net redemption value will be 1000 minus 30, 970, 1000 minus 40, 960, 1000 minus 40, 960. Exactly same format. I have not changed anything. This will save time for you. Now we will write down step number 2, interest net of tax. Interest net of tax. Interest net of tax. Right hand side 2 columns again, bond A, bond B. Bond A, bond B. Under bond A, write down face value 1000 rupees, 1000 rupees. Coupon rate, write down 12% and 10%. Coupon rate 12% and 10%. Interest amount will be 120 and 100. Ready? 120 and 100. So what will be interest net of tax? Tax rate is 30%. So on 120 you pay 30%. You get 84 rupees net in your pocket. On 100 rupees you pay 30% tax. You get 70 rupees in your pocket. So interest net of tax will be 84 and 70. So once these basic working notes are ready, now you can solve YTM. So step number 3, write down YTM. Bond A, bond B. Bond A, bond B. YTM is equal to, what is the formula? The formula is, if you want to write the formula, you can write here C into 1 minus T plus RV minus NP upon N upon RV plus NP by 2. So write this formula in this column. And now you see we have already done some basic calculation. Coupon less tax 84 for bond A plus 970 redemption value minus 700 current market price divided by 10 years upon 700 plus 970 divided by 2. So write this, solve it on your own. Solving part you will do on your own. Come to bond B. Bond B interest net of tax is 70 plus 960 minus 600 upon 6. 960 minus 600 upon 6 and the whole upon 600 plus 960 upon 2. 600 plus 960 upon 2. So how much it comes to? It comes to, check the answer with me. The first answer, bond A, please check, 13.29%. Is it right? 13.29%. Tell me, is it right? Second answer, check. Yes, second answer is check 16.67%. 16.67%. So this way you can solve the problem of taxation. One more question I will dictate where one more adjustment has come, tax rebate. So how will you handle this also? Like as you know, when you invest in certain types of bonds under Income Tax Act, at the time of investment only you get some tax rebate. Okay, so in that case your again the YTM will change because of that tax rebate also. So we will take into account the effect of tax rebate in the YTM calculation. So are you ready to write a new question? Say yes, yes, start. So question also you have to write, a bond has following features. A bond has following features. Right hand side rupees. First point A write down, face value rupees 1000. Face value rupees 1000. B, original maturity 10 years. Remaining maturity 5 years. Original maturity 10 years. Remaining maturity 5 years. Issue price 990. Issue price 990. Current market price 962. Current market price 962. Coupon rate 12%. Coupon rate 12%. Table closed. Next paragraph. Suppose income tax rate is 30%. Suppose income tax rate is 30% and capital gain tax rate is 10%. And capital gain tax rate is 10%. Then there is a line which is different, hence I am taking this question. There is a tax rebate of 20%. There is a tax rebate of 20% on investment in this bond. There is a tax rebate of 20% on investment in this bond. Calculate post-tax YTM. Calculate post-tax YTM. Okay. So first 20 seconds you will try. I will give you time to try 20 seconds. Whatever you think, try. Even if it is wrong, then don't worry. I will do it. But at least you should try. So I am checking how many of you are trying. Whatever comes to your mind, suppose a new question comes in the exam which is not asked so far, then how are you going to tackle it? If you try, you will succeed. If you don't try, you will never succeed. Success belongs to those who take efforts and try. Right? So have you done? Have you done? Have you done? Right. So we'll check the answer now. What is confusing about this question now? See, original maturity is given 10 years, remaining maturity is given 5 years. Now, if you are going to purchase this bond today, you are only going to look at what is remaining now. What has gone, has gone. Bygones are bygones. What is remaining is important. So 5 years is important, 10 years is not. Second, when this bond was issued, 10 years bond means 5 years ago, when it was issued it was 990, but today if you buy this bond, the price is 962. So again what is relevant is the current price of the bond, that is 962, not 990. and when you will purchase this bond for 962, you will get tax rebate. You will get tax rebate of 20%. So 962 you will pay, 20% you will get as tax rebate. So your effective investment, effective outflow to buy this bond is 962 minus 20%. Okay. So dear student, first step 1, which is a new step in this problem, and that is why this question is important, is to find out the initial investment amount. So I will start with step 1, net initial investment. Net initial investment, right hand side rupees, current price of the bond 962, but you will get a tax rebate on that. So you are paying 962, you got 192.40 immediately as a tax rebate. Okay, so what actually flows out of your pocket is the net amount. That is the benefit of investing in bonds. Immediately you get a rebate, and that increases your rate of return. So net initial investment is 769.60. 769.60. So this I will require as initial investment. Now come to step number 2, net redemption value. Net redemption value, like we did earlier, we'll do it now. So first point A is redemption value. How much is the redemption value? Redemption value, look at the question, 1000 rupees. And what is the price at which you will purchase the bond? The price at which you purchase the bond is 962. So for tax calculation, we will take 962 as the cost of acquisition, not after deducting that rebate. So for tax purpose, the cost of acquisition will be 962. Point number C, capital gain. Capital gain will be A minus B. Just check, is it 38 rupees? So you have to pay a capital gain tax. Point number D, capital gain tax of 3.80 rupees. Capital gain tax at the rate of 10%, 3.80. Is it right? So now my question is, what is the net redemption value? How much will come to your pocket? You will get 1000 rupees. Now this time reverse. You will get 1000 rupees and you will pay 3.80 taxation. So your net inflow or net redemption value will be A minus D, and that is 996.20. 996.20. Step number 3, write down interest net of tax. Interest net of tax. This is easy. You can avoid this working note and you can write directly in the main answer also. Those who want to write can write quickly. Interest net of tax, right hand side rupees. Point number A. Interest net of tax, right hand side rupees. First write down A, face value 1000 rupees. Agreed? Face value 1000. Interest is always paid on the face value. Point B, coupon rate 12%. Coupon rate 12% is given. Therefore, point C, interest amount will be, now check whether it is an annual bond or semi-annual bond. So I have to make a small change in the problem. Coupon rate 12%. Just write down payable semi-annually. Payable semi-annually. Payable semi-annually. So what will happen now? Your coupon amount will be 1000 into 12%. Into 12%, this is percentage, 12% into 6 by 12. into 6 by 12. So it comes to 60 rupees. And then you have to pay tax on that. Interest amount net of tax. Interest amount net of tax 60 minus 30%, that is 42. 60 minus 30% is 42. So 42 is what we will pay. So now write down the formula. It is a coupon bond. I can apply the formula. YTM is equal to C plus in bracket RV minus NP or P divided by N upon RV plus P by 2. So you can use a symbol P or NP and then explain it below. So in this question I am going to ask you to compulsorily write the meaning of this term and their values against it. Okay, easy for you for understanding. In future when you revise it, it is very easy. So write down below where C is equal to coupon net of tax. C means coupon net of tax. So I have already adjusted tax here 42. RV stands for net redemption value 996.20 already calculated. P means initial investment equal to 769.60 already calculated, and N is the remaining maturity. So as I have said, it is a semi-annual coupon paying bond. So I will take 5 years into 2. 5 years into 2, 10 periods. Put these values in this formula. Put these values in this formula and give me the answer. So put these values in this formula and give me the answer. Check. This way you will put the values first. 42 plus the difference between net redemption value and the net initial investment apportioned over 10 years. That is also a benefit to you, and divide by the average of the two, 996.20 plus 769.60 divided by 2. Now you will get 7.32%, but what is the mistake you will make? You will think that this is the final answer. No, this is not the final answer. This is the YTM for 6 months, because we have used semi-annual formula. So even the YTM that you are getting is applicable for 6 months. So what will be annualized YTM? Tell me, what will be annualized YTM? It will be multiplied by 2. So therefore, below this write down annualized YTM 7.32 into 2. 7.32 into 2 is 14.64%. 14.64% per annum. If you are using half yearly interest payment, and if you are using the formula, the YTM that you will be getting will be for 6 months. So you write both the answers, YTM for 6 months and YTM for a year, annualized YTM, double of that, 14.64% per annum. Now I am going to ask you to write a small note first before we go to the next question. The next question deals with YTM of a perpetual bond. The next question 27 will deal with YTM of a perpetual bond. So a small 2-3 line note will be useful. So write down YTM of a perpetual bond. Heading is in your notebook, YTM of a perpetual bond. Next line, YTM of a perpetual bond is given by, very easy. Even if I don't tell you, you can do it. YTM of a perpetual bond is given by that rate of discount. Now start writing from here. That rate of discount from here, at which PV of outflow is equal to PV of inflow. That is the YTM of every bond. PV of outflow is equal to PV of inflow. This is the formula for IRR also. YTM of a perpetual bond is that rate of discount at which PV of outflow is equal to PV of inflow. So why this bond? Every bond. What is the PV of outflow in case if you want to invest in a perpetual bond? The outflow will be current price of the bond. The outflow will be the current price of the bond, and it should match with the inflow. Inflow will be coupon amount, because you are not going to receive the principal amount. Only coupon is received. Perpetual bond only pays coupon year after year, forever, and that will be discounted at YTM. Now in this equation, the left hand side is PV of outflow, the right hand side is PV of inflow, but I am interested in this number YTM. So what I'll do, I will bring the YTM on the left hand side, and I will take this current price on the right hand side in the denominator. So the formula for YTM we have just now derived ourselves is equal to coupon amount upon current market price of the bond. Coupon amount upon current price of the bond, and that is very easy. Even if you don't want to remember the formula, you know the basic formula of price of the bond. Using that also you can find out the YTM. Okay. So now we'll discuss one question number 27. A ₹100 perpetual bond is currently selling for ₹95. A ₹100 perpetual bond is currently selling for ₹95. The coupon rate of interest is 14.5% and the appropriate discount rate is 16%. Calculate the question 1 value of the bond. What is the YTM of the bond and should it be bought? These are the three questions. Value of the bond is equal to, as you know, annual coupon divided by your desired rate of discount, which is 16%. So 14.5% of 100 means the coupon will be 14.50 and you divide by 16%. So that will give you value of the bond. Okay, price of the bond. That is what you want to pay. And if they ask YTM of the bond, the YTM will be the annual coupon, which is 14.5 divided by current price. Divided by current price. Divided by current price is 95. So if you buy this bond at 95 and if you are getting 14.50 every year, how much is the rate of return you are earning? That will give me YTM. Now the question is, should it be bought? There are two ways I can answer this question. I can compare current market price ₹95 with the intrinsic value in question number 1, or I can compare the required rate of return 16% with the YTM. Okay, there are two ways I can compare. Either I can compare the rupee value, how much I am willing to pay versus what the bond is trading at, or I can compare how much rate of return do I want versus how much rate of return this bond is offering me, and then we will write this answer. So one by one. First write down step 1, calculation of intrinsic value of perpetual bond. Write in the notebook, calculation of intrinsic value of perpetual bond. Calculation of intrinsic value of perpetual bond. Formula for a perpetual bond is A upon R. Annual coupon upon rate of discount, rate of return required. Annual coupon is 14.50. Required rate of return of the investor is 16%. So take your calculator, check 14.50 divide by 16%. How much is that? 90.625, right. Now second question is perpetual bonds YTM. So write down YTM of perpetual bond. YTM of perpetual bond is equal to coupon amount upon current price of the bond. Coupon amount upon current price of the bond 14.50 upon 95. 14.50 upon 95, and that comes to how much? 15.26%. 15.26%. Just check. 14.5 divided by 95 is 15.26%. Step number 3, evaluation. The third question is whether we should buy the bond. So let us compare market price with intrinsic value. You can compare price to price. So market price is greater than intrinsic value. You want to pay some amount, but the market price is more than that. So market price is greater. So bond is overvalued. Write down step 3, evaluation. The market price is greater than intrinsic value. Therefore, the bond is overvalued. Therefore, the bond is overvalued. Hence, it should not be purchased. Hence, it should not be purchased. Hence, it should not be purchased. Then write down next paragraph. We can also say that the YTM is 15.26%. We can also say that YTM is 15.26%, which is less than the required return, that is 16%. YTM is less than required return, that is 16%, comma, the bond is overvalued. The bond is overvalued, comma, it should not be purchased. It should not be purchased. The bond is overvalued. It should not be purchased, right? So this answer is over. Now we are going to write one more note. In your notebook, write down next paragraph, heading, if possible, write in capital letters YTM of a zero coupon bond. YTM of a zero coupon bond. Just again write down few lines. First you should know what is a zero coupon bond. These are such bonds that do not pay any coupon. You will invest an amount, you will get the redemption value. So you have to find out at what rate of return your investment value will become equal to redemption value. So write down a note. Very easy. YTM of ZCB or DDB is given by that rate of discount at which PV of outflow is equal to PV of inflow. PV of outflow is equal to PV of inflow. Therefore, next line, equation for zero coupon bond already discussed with you. The price of the bond is equal to, this is what we pay on the left side, this is what we receive, face value or redemption value upon 1 plus R to the power n. Face value or redemption value will get on maturity, and that is discounted by R and n combination. Now in this equation, what you will do, You will be given price, you will be given redemption value, you will be given number of years. The missing figure is R, and this R is the YTM of a zero coupon bond. Solve and find the value of R, which is the YTM of zero coupon bond in this equation. Solve and find the value of R. Is it right? Can we go ahead? Is this formula new to you? No. But now what they will do, they will give you issue price, redemption value, time, and then the student has to solve this equation and find the value of R. So I am going to dictate one small question to you. Please write. Write down in the notebook question. Calculate the YTM of following zero coupon bonds. Calculate the YTM of the following zero coupon bonds. This is a question I am giving it to you, very important, in bracket, very important. Serial number, particulars, bond X, bond Y. Bond X, bond Y. Two bonds I will give you so that you will have double practice. Credit rating. Both bonds have same credit rating, AA. So you must be aware that in case of bonds, they usually get this bond credit rated. Credit rating helps them to, or the investor to understand the risk involved. The highest safety bond is given AAA rating, and AA means it is safe but not as safe as AAA bond. So some degree of risk is there, but still it is very safe bond. By looking at the credit rating, the investor may decide whether to invest or not, and this helps the companies also to raise the funds if they get better credit rating. In India, credit rating is given by some reputed credit rating agencies like CRISIL, 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 ICRA, 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 or CARE, CARE, right? But we don't have to remember any credit rating. We are always given credit rating in the question, and we don't have the topic credit rating in our SFM syllabus. If you want to learn about credit rating companies, then in your FSCM elective paper, Financial Services and Capital Market, there is a full chapter on credit rating, and that time you will understand different credit rating companies in India, the symbols that they use, how do they operate, international credit rating companies like Standard and Poor, etc. For the time being, let us go to the next line. Maturity. Both bonds have same maturity also, 5 years, 5 years. Face value 1,000, 50,000. Price is 610. 33245. Which bond will be preferred? Now just don't look at the price and say, oh, bond X is 610 only, I'll buy this, this is cheaper. No. In case of bonds, we don't compare the two bonds on the basis of their prices. We compare the bonds on the basis of their yield. Which bond is giving higher yield? If they have the same rating, then I will choose the bond which have higher yield. So I will need to find out their yield. And to help you to solve the problem, they have given you some factors also here. 1.63934 to the power 0.2 is this number, and 1.50398 to the power 0.2 is this number. What is the nature of the bond? These are zero coupon bond, which means you will invest 610 rupees, you will get 1000 rupees after 5 years. So what is the annual compounded rate of return you are expected to earn? In bond Y, you will invest 33245. It will become 50,000 after 5 years. So what is your annual compounded rate of return? So let us solve one by one. First write down bond X. Bond X. Price of the bond is equal to face value upon 1 plus r to the power n. This is the equation. So now I'll put the numbers. 600 is equal to 1000 upon 1 plus r to the power 5. So can we now just simplify this? I'll bring 1 plus r to the power 5 on the left side, and I will take 1000 divided by 600. So how much is 1000 divided by 600 equal to? So this 1000 divided by 600 is equal to 1 point, I think you are getting 6666. Oh sorry, it is 610. 610. This number is 610. Make it 610. Now check. 1000 divided by 610. Is it 1.639234? Now I have to find the fifth root of this number. So that will become 1 plus r is equal to 1.63934 to the power 1 by 5. To get the value of 1 plus r, you have to take the fifth root of this number, which is equal to 1.63934 to the power 0.2. Now that question has given you the value of this number. So the value of this number is 1.1039. Therefore 1 plus r is equal to 1.1039. 1 plus r is equal to 1.1039. This factor is given, otherwise you can also calculate. So what is your value of r is equal to? The value of r is 10.39%. Is it right? So bond X I have solved. Dear student, write below bond Y, solve yourself. I'll give you 5 seconds. Solve for bond Y. I'm waiting for you. Yes, try. Come on. In the same manner, solve for bond Y. Are you solving? Solve for bond Y. So let us check the answer. That was quite easy. Price of the bond is equal to same formula. 33245 equal to 50,000 upon 1 plus r to the power 5. Then you take on your calculator 50,000 divided by 33245, 1.50398. 1 plus r is equal to 1.50398 to the power 1 by 5. And the value of this factor is given in the question as 1.0851. Normally it will be given. If not given, I have given you the trick how to solve it. Therefore r is equal to 8.51%. In case of bonds, do not make the mistake of comparing their current price, because bonds have different face values. You can't compare their prices. Then how do you take a decision? Compare their yield, and the one which offers you higher yield for the same risk. The risk is same, double A. Then you can go for the bond with higher yield. So write down the note. Bond X will be preferred. Bond X will be preferred because it has higher yield. Bond X will be preferred because it has higher yield. Write down one more question. On zero coupon bond, I will give you one more practice. Please write down question. Consider a zero coupon bond issued by we know, victory of knowledge. Face value rupees 25,000. Maturity 25 years. Current market price 1792. Yield on similar bonds 11% per annum. Yield on similar bonds 11% per annum. Calculate 1. Bond's intrinsic value. YTM of the bond issued by we know. YTM of the bond issued by we know. And 3. Write down give your advice. Give your advice. And to help you, they have written some factor given 13.9509 to the power 0.04 is equal to 1.1112 is equal to 1.1112. Okay. So now what will you do? You will first find intrinsic value. Intrinsic value means present value of face value discounted at your required rate of return. How much you are willing to pay. So you have found that in the market similar bonds are giving a yield of 11%. So I will expect 11% from this bond. So you will discount 25,000 at 11% per annum, and whatever value you will get is intrinsic value. Second question is YTM of the bond issued by we know. To find the YTM of the bond, you will take 1792, that is the current market price, is equal to face value divided by 1 plus R to the power 25. By solving the equation, you will find the value of R, that is the YTM, and give your advice. There are two ways you can give advice. Either compare current market price with intrinsic value, or compare YTM with the required rate of return 11%. So you have to get YTM in question number 2, that can be compared with 11%, or you can compare the price versus intrinsic value. So dear student, first write intrinsic value of the bond IV. Intrinsic value of the bond in bracket IV is equal to face value upon 1 plus R to the power n. Face value upon 1 plus R to the power n. What you want to pay is called intrinsic value. So intrinsic value is equal to 25,000 divided by 1 plus 0.11 to the power 25. This you can get on your calculator. Type 25,000 and divide by 1.11, press equal to 25 times. So check the answer now. I am getting 1840.20. How much you are getting? Same? Very good. This is intrinsic value. And how much was the market value? 1792. Oh, very good. This time this bond is undervalued. Next heading write down calculation of YTM. Next heading write down calculation of YTM. Next heading write down calculation of YTM. So equation write down price of the bond is equal to face value upon 1 plus R to the power n. 1792 equal to 25,000 upon 1 plus R to the power 25. So we will now write it like this: 1 plus r to the power 25 is equal to 25,000 divided by 1792 is coming to 13.9509. 13.9509, which means 1 plus r will be 25th root of this number. So 13.9509 to the power 1 by 25, which is equal to 13.9509 to the power 0.04. Check the mathematics. Is it right? So one good news is that the value of this factor is given in the question 1.1112. 1 plus r is equal to 1.1112. Therefore, r is equal to 11.12%. R is equal to 11.12%. So write down the note. The question was, should this bond be purchased, or advice? The advice is this bond should be purchased. The bond should be purchased because its YTM. The bond should be purchased because its YTM is higher than yield on similar bonds. Because its YTM is higher than the yield on similar bonds. Because its YTM is higher than the yield on similar bonds. Right? Similar bonds are giving 11%. This bond is giving 11.12%. You can also answer on the basis of intrinsic value and current price. Next line, write down. Alternatively, we can say that the current market price. Alternatively, we can say that the current market price of the bond is less than the intrinsic value of the bond. The current market price of the bond is less than the intrinsic value of the bond. The current market price of the bond is less than the intrinsic value of the bond. Therefore, the bond is undervalued. Therefore, the bond is undervalued. The investor should buy the bond. The investor should buy the bond. Okay. So now we'll take a break.